Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Friday, the 12th of July, and it is the last day of our season, as it turns out. And Brent crude oil trading above $85 a barrel, a little bit up this morning by a third of nothing dramatic, but nonetheless, it is in a sort of very tight band for some time now. After we had that big recovery since the early June sell-off, we've had a $10 recovery and we've kind of plateaued around $85 to $86 a barrel. Let's kick off this morning with Kieran Gallagher, Managing Director of Vitol Bahrain. And Kieran, if we might just start with ultimately the news of the day, or one of the pieces of the news of the day, and how extreme heat, is impacting or could impact refinery operations across the world, particularly in Europe. Your thoughts on that being a factor for the markets, both on the supply side, of course, refinery supply products, but also on the demand side, if indeed we need to be burning extra fuel oil. But let's deal with the impact on refineries first.
Yes, good morning, Sean. Good morning, everyone. Yeah, you're 100% correct, Sean. I would say it's perhaps the European refining sector that tends to suffer the most in extreme heat. Obviously, they're not built for temperatures in mid-30s, mid to high 30s. So we did see it. There's been a couple of fairly recent experiences over the last couple of years where we've seen a drop off in runs, units performing poorly. Particularly last year, there was weather was attributed to some outages in both the Med and ARA. I think largely, I would say though that the refining sector has been performing pretty admirably this year. So if there are some small scale outages because of weather and where runs drop 2-3%, it won't be the end of the world. We are seeing extreme heat in the Middle East at the moment, and yes, you can point it's July in the Gulf. What do you expect? But it's actually been a very early summer. You'll have experienced it obviously with where you're currently standing. The government here in Bahrain have issued warnings for this weekend where the real fuel will be above 50 degrees, and that's extreme for Bahrain, to be honest. And we have obviously seen blackouts in Egypt, in Iraq, even some in Kuwait, just due to the extreme pull on the power gen sector because of the early summer and real extreme early summer conditions that we even experienced in June. So not in answer to your question, I would say not unusual to get some outages. Certainly a tick up in demand for air conditioning reasons, particularly in this part of the world, and we're seeing a real pull on the electricity sector because of it. But yeah, if we're to see another heat wave in Europe, much like last year, I would expect a couple of runs to come off a couple of percentage points.
Let's go to Paul Horsnell at Standard Chartered, Head of Commodities Research at Standard Chartered Bank. Paul, by listening to Kieran there, you'd say the heat, at least from the point of view of the Middle East and other places, might be a demand pull. And Saudi Arabia, as we know already, burns a lot of fuel oil for power generation in the summer months. Could this deliver more? Also on the demand side, we had some news overnight. So in that sort of incremental Fed watch space, we're seeing more data coming through that would sort of signal that the Fed are finally going to move on rate cuts. Your thoughts on the inflation number printed in the US overnight, and where the Fed goes and its impact for the oil markets?
Yeah, morning, Sean. I think on the inflation print, we had that funny period during the year where it really didn't matter what the US economy did. People sold oil. If it looks of interest rates were getting closer, then they'd sell oil because it meant the economy was weak. If interest rates were still going to remain elevated, you sell oil because of risk assets, etc. I think it's becoming more unambiguous now that uh, uh, interest rate cuts are positive for the oil market. I think I'm to the point now, particularly if they're coming from a reduced inflation. So, without putting prices back on the tear, it was certainly supportive from the macro side. And I think the theme for really the whole period you're going to be away is going to be this pull between sort of top-down macro flows of money coming into the market and the more supply-demand based fundamentals. And really, this is the quarter where the fundamentals should be coming through. Supply is not really going anywhere. Demand seasonally should be increasing. In Lewis Hamilton terms, this is hammer time as far as the oil market is concerned. It should be going the fastest here that it goes at any point during the year. So within that delicate balance, I think maybe the macro might take a little bit of a back seat, but as it stands, and particularly that inflation print, it's supported. Nothing more than that, but certainly supported.
Gaurav Sharma, good morning. Good to have you back at the table, a journalist and energy analyst with a long resume of engagements across the world. Gaurav, hearing Kieran's thoughts there that the maybe demand pull on with the need to burn more oil for air condition or for power generation in the Middle East. Paul saying the inflation numbers looking good for possible cuts coming from the Fed, and we also have a pretty decent look of draws on inventories, and the but. Gaurav, the but is oil prices are dormant. They're uninterested in these bullish factors. Why?
Good morning. Good to be back. Look, last when we had the specter of the market being oversold. Then we had this thing about is it overbought? I think the truth is somewhere in the modest middle. Demand is going up, but as we've noticed, as we've discussed on this podcast several times before, that the big data aggregators, they can't agree themselves where demand is heading. Looks like it is edging higher, as colleagues have just referred to. Now, how price supportive is that? I think, look, it's a sentiment-driven market. I would say that there is a case, a cautious case for defending oil hitting 90, but I can't defend it going higher than that, primarily because I keep a very close eye, especially on the light sweet market. There is an abundance. There's no paucity of supply on the light sweet front, maybe on the heavy sour front. So you might end the year whereby which there is some sort of a surplus of light sweet, but perhaps a little bit of a deficit of heavy sour. Let's see where this goes. I can defend oil going to 90, but I don't see how you'll have.
How does it get to 90? If you're it seems stuck in 85 to 86. What would be the trigger to go an extra $4? That would need a sort of a breakout.
I was looking at some of the American political discourse over there, and they're saying, well, an interest rate cut is priced in for September. There's like a 90% probability, but there's always this sort of overhang that who will incur the wrath of Donald Trump, that he sees it as a political cut. I think that's a bit far-fetched. Powell will do what Powell needs to do, and 90%, that's what most of the colleagues are suggesting. That's the sentiment surveys from Bloomberg, Reuters seem that it is priced in. Now that should serve as a bit of a positive factor. A softer dollar will likely have sort of non-US currencies who are looking to buy in the market, looking to drive the oil price slightly higher based on demand. So it is likely to pick up. Keep a close eye on the driving season, of course. And of course, if we look at the IATA S&P Global calculations, jet fuel demand is on the up. So these are two things that I'd say might push oil, nudge it higher towards 90.
Kieran, one of the big factors, although Paul did reference that, supply is sort of as steady as she goes and predictable to a great extent. But Kieran, we have the big decision by OPEC Plus to increase supply come October 1st, which of course is just around the corner from a planning point of view. With OPEC due to meet next, OPEC Plus, I should say, on August 1st, when everybody is at the beach. Are the conditions lining up with to sort of cater for their proceeding with these increases in supply? Your thoughts on the context of OPEC increasing supply into the fourth quarter, Kieran, and the conditions stacking up now to support that?
Yeah, I think we would need to see a tick up in product demand really to drive that. It's only a month or so ago we saw some real margin compressions, refinery margin compressions, and concerns over product demand growth. As Gaurav has just said, there has been a tick up in jet demand, but there's probably a little bit of room to go on jet, particularly in the long haul sector, because as we see it, it's probably jet demand's probably only 1% above 2019 levels at the moment, around 7.5 million barrels per day. So I think it would need to be product led, Sean. The refineries calling for this. In recent weeks there has been a little bit of a squeeze on crude availability, and we've seen a recovery in margins, but looking forward, I think is it 2.2 million barrels that OPEC Plus are hoping to bring back onto the market gradually from October onwards. We can't really forget the non-OPEC supply as well, and that's been growing healthily. And I think over the course of this year, probably we're going to see a growth in supply in 2024 of about 1.5 million barrels, half of that from the US. So there's barrels on the market competing with that OPEC Plus supply. So I think we would need to see a real pickup in product demand to be able to house that extra supply of crude coming to market.
Paul, of course, that extra demand typically comes from Asia, where Standard Chartered Bank is one of the leading banks in the Asian and emerging markets. What's the outlook there? Do you think China, the second half, we got a big meeting by the Chinese government next week. The sort of select committee, the head of the Communist Party has what's the third plenum it's called out of their 5-year program. Can we expect China still to come back to offer something next week when they meet? They have in the past. The third plenum has delivered some big policy breakthroughs. Your thoughts on the outlook for Asia to be that extra demand, incremental growth in the second half?
Yeah, I think first have to sort of just make proviso. There's been a certain decoupling between oil demand in China and macroeconomic conditions. So, it's not a straight line between necessarily in the short term between the two. But I think it's only fair to say that in the very short term, both business confidence and is still very weak in China. I think there's a very pessimistic outlook among really firms of all type, and a lot of that pessimism is also shared by some of the key policymakers. I think that sort of clouded outlook on the economy is fairly shared. So again, I'm not the lead China economist, so I'm not going to give a sort of direct read through. But I think if you were looking for the conditions under which at least money would be used in a more optimal way rather than new money being found. If you're looking for conditions under which there would be some actions, it would be this sort of thing where everybody is pretty much agreed that the outlook is it's a bit grey, nothing's falling off a cliff. And so under those conditions, you would expect some kind of supportive actions to come through at the plenum, but again, we'll see what emerges. But probably not sort of big bang, huge a stimulus of the past. We probably moved beyond that at this point.
In terms of imports, Paul, into China, obviously we've seen the big headlines with Russian crude oil making its way to China and that discounted price, and that we've seen in since the invasion of Ukraine and the detouring of oil around the world. China's been the big benefactor of that, but also of Iranian oil now really ramping up in the last year or so. Where is China enjoying or continuing to enjoy discounted crude oil imports from those two suppliers?
Well, again, officially, there is no Iranian crude going into China, according to the numbers. There's a suspiciously large amount of Malaysian crude going in, but again, that's very much a story. I mean, it's always been, China values relationships with suppliers. China's always will also look for the best value crude, and I don't think anything there has changed. But I don't you can necessarily infer from either countries an increased use of Russian crude as being anything other than pragmatic. It doesn't despite what Modi did this week, doesn't necessarily feed through into a political support. But for the moment, it is while there is some discount, or it is, let's just say, the crude is good value. Then there continue to be flows moving in. I think that seems fairly clear, unless it gets tied up into a wider dialogue, and in which case, as soon as the incentive isn't there to take that crude, it won't be taken. I mean, Russia has not locked in a market. It's got a market by providing something which has economic value for the moment.
Gaurav, looking at the Russian story and the sort of wider geopolitical narrative, which has been over the sort of first half of the year, at moments a very significant support to the oil market, and has propelled it, as we saw, more spectacularly. You were saying earlier about what might get to 90. Well, we did get to 90 and over it in the first half on one occasion when Iran and Israel faced off on what looked like to be the edge of a possible cliff of wider conflict in the region. It stepped back from that. But now it seems in some ways Europe is the epicenter of geopolitical risk with all of these elections, fractured governments. I mean, obviously the Labour has come into power with a fairly solid majority, but nonetheless, we see that fracture across Europe. The French in particular. Where are we with geopolitical risk, do you think, Gaurav, going into the second half over the summer, starting with Europe and the Ukraine war?
Sure, I'll go back to what I've reiterated often. I think the risk premium, as we call it, it's there, but it's not what it used to be. If you look at the turn of the last decade, with the turn of this one, a midway point through this one almost. So it's not what it used to be. Primarily because the US and non-OPEC supply is pretty robust. But risk as a whole, if you look at it, a lot hinges actually, even for the Europeans, on what happens in November in the States. Now, this whole Ukraine problem, if I may say so, for the Europeans, and the tragedy in a much wider context, the Europeans cannot on their own, on a standalone basis, sustain this particular war, right? So if, say, a potential Trump presidency creates some kind of a pullback, then there is that factor to consider. Secondly, when the geopolitical infraction happened between Iran and Israel, as I said at the time, no critical bits of infrastructure were hit. There were skirmishes, there was saber rattling and that sort of thing. So when you look at the kind of risk we had at the turn of the last decade, the situation was very different. There was no room for error. But right now, with non-OPEC supply being reasonably robust, there is some room. Of course, you'll see some kind of infraction, but we had sort of like a double-digit risk premium, towards the turn of the 2010, 2011, 2012, and always upwards. That's come down to sort of single digits by my modeling. So the premium is there, but it's not what it used to be.
Are there growing signals, Gaurav, just to sort of double down on that the Ukrainian war is threatening to escalate? I mean, we're seeing a lot of activity. We had the Indian Prime Minister there this week in Russia. We had the Hungarian Prime Minister there. The U.S. has sanctioned extra weaponry to be used in their jets to sort of again escalate the weaponry that's available to the Ukrainians. I mean, does this look like it's coming to an end game with this posturing, or is this look like actually this is scale up? Because I think that's really where the premium is going to start to gamble or to guess. Is this because a lot of narrative around getting to end game, everybody's exhausted, but yet things are ramping up. Your thoughts on that? Typically, summer is when that happens.
I suspect so. I think Moscow's gamble is that if they accept a chunk of Ukraine that they already have and call it quits at that. That is not something that is acceptable to Kiev and to Zelensky. Now, what Putin's gamble is that if it's a Trump White House, probably the Europeans fall in line and say, all right, let's call it quits. You keep the chunks of Ukraine we have, and we have a North Korea, South Korea type situation where there is peace. There is no peace on paper, but from the physical aspect, there is some peace, and that is what he's gambling on. That the chances of that are pretty high, depending on what happens in November. But what will that happen is it will considerably lower the risk premium further, actually. So yeah, a lot is injected in that. So yeah, let's see where it goes. But that's Moscow's gamble.
Let's go to the survey question, which is sort of taking an outlook to beyond the summer, whereas this is the end of our season, and what will be the price of Brent crude oil after the summer season on September 1st, when everybody gets back to at least the sort of new cycle of business after the August disruption. Will it be closer to 95, 90, 85, or 80? At the moment, we're sort of stuck, not stuck, but comfortably so, at that $85 level. Will it be closer to 90, or will it be one of the others? If you make your choice. Kieran, I wanted to get everybody to give us a sense of while the holiday season kicks in, the silly season, and people get distracted and liquidity tends to reduce. What will you be watching for the markets over this period, and how could the liquidity impact the direction of travel?
Yeah, I think, interestingly, I think managed money flows are currently, towards the 2-year highs in the market at the moment. So as you say, it is, this next 6-week period is traditionally a time where liquidity drops, holidays, and perhaps a lack of action, maybe beyond hurricane season in August. But it is interesting that we have seen that influx of managed money to the market, and there's some, you could say that there's some evidence that is keeping the price elevated towards that $85 at the moment, because as Gaurav rightly said, and Paul, that the risk premium isn't what it used to be, or the geopolitical risk premium isn't what it used to be. So I think we will be keeping an eye on that, keeping an eye on demand, really. And as you say, there's an OPEC meeting on August 1st. Obviously, the eyes of the world will be on that for any big announcements. Probably don't think there's going to be anything huge to come out of that. And so, yeah, I think that's the main focus at the moment. And
it sounds like you're saying this is not a period to go away to the beach, short this market. If you're going, you gotta stay long.
Well, not necessarily. I think it was interesting that there was such a large hurricane so early in the season, as you discussed earlier this week on the podcast. And with that was obviously going into a long weekend, but as near as you can get to a 4-day weekend in the US, and therefore it did attract some managed money flows. It doesn't look like there's a huge amount of tail risk in terms of refineries coming back in the US Gulf, or crude production coming back. So I guess we would be interested to see does a little bit of that flow come back out of the market over the next week or so. But I'm not sure. You know, as you say, the war goes on. There's still friction in the Middle East. We are going into hurricane season. Is it safer to be long? Yeah, you could argue so, but $85 is not a low number, you know?
Yes, that's true. It's not a low number. Paul, your thoughts as you go on your virtual holidays, or your real one, let's hope. What do you think the market needs to keep an eye on in order to cover their positions through to September?
Yeah, I had my holiday last week, so I'm here for the
Oh,
duration.
right.
But
I thought you were looking a
think,
little suntan there.
Albania, yes.
Lovely.
We'll come to that another time.
Yes.
I think the thing I've sort of add to that is, it is the high frequency data. It's the trend in the US data. The last couple of weeks have been the first 2 consecutive weeks since February where we've had bullish US weekly data, each week. It's not much of a run, it's 2 weeks, but I think there are enough suggestions that high frequency data is going to deliver a stronger trend over the course of the next few months. If it doesn't, I mean, this is back to hammer time. Hammer time does involve a tightening of inventories. It shows that there's nothing that helps a market move up more than a consistent run of strong US data. So I think that's probably going to be key. It is back to pure fundamentals. I mean, I disagree about $85. I don't think that's high at all. I think that's remarkably low. It's a price at which US producers are cutting drilling, cutting expenditure, don't seem to be able to make much of a living. I mean, 85 is not a high price. I mean, we had over 100 for 5 years, over a decade ago. So I feel this sort of plateau, 90 is a bit too high, and 85 is sort of Goldilocks.
Well, when you think about 6 million barrels being locked in, I suppose 85 is a high price. So it's managed market in a way.
Yeah, I mean, it's not 6 million barrels, and B, spare capacity isn't locked in. It's spare capacity that's there to help manage the market. I mean, there's a lot of countries sort of says, as if all spare capacity is a dreadful thing and means prices should be lower. I mean, we'd normally expect spare capacity around about 5%, which is anything less than that, and you start getting a little bit concerned. So I wouldn't worry about it in terms of spare capacity. Look to the major players. What do the major players want? I mean, do the main OPEC plus, and particularly the Gulf producers, are they happy with 85? They'd accept it, but it's clearly not feeling like a stabilized market or a higher market.
And well, the IMF has said the Saudis need, I think, closer to 100 in order to balance their budget.
And then again, this is back on to believe that the price has to be the fiscal break even. I mean, my own country hasn't run a balanced budget since the Napoleonic Wars. It doesn't matter. Saudi Arabia has reserves. It has it can access credit markets. Has very strong credit. So it's not the price they need for fiscal reasons, but I think the price which they feel is a fair price and sustainable price is perhaps a little bit higher than current prices. And we just have to look to the fundamentals to see whether those would be consistent with higher prices. So I fear I'm going to have a rather boring July and August, and actually we'll be looking at data quite a lot, because I think by September we're sort of merged saying, okay, those fundamentals weren't there, but they should be delivering. I mean, last thing on that, back onto the round of monthly reports and IEA, EIA, etc.
Yeah.
The headlines were all, well, demand is slowing, but that's all rear view mirror. If you look at those forecasts, they all have an acceleration of demand into Q3, Q4. The IEA has year-on-year growth of 1.5 million by Q4. And the other big change in those reports was actually for next year. The EIA number is almost the same as the OPEC Secretariat for next year. There's about 100,000 difference between them, at sort of 1.7, 1.8. Massive upwards revision on their 2025 number. So perhaps, we're at the one thing that will be different in September is we would just sort of shift it over to be more worried about the 2025 demand look. And 2024, normally sometime around September, October, tends to sort of just disappear a little bit, exit stage left pursued by bear sort of thing.
Gaurav Sharma, last word to you. What do you think we should be watching? The market should be keeping an eye on, one eye at least, when they're slapping on the suntan oil, so as not to be exposed, not to use all of the analogies in the book. But your thoughts, Gaurav, over the 6 weeks to September 1st?
Sure thing. I think I'll be somewhere between Kieran and Paul. I think we're probably looking at sort of a smidge above 85. I do think, Paul, apologies. I do think I agree with Kieran. I think 85 does look like a reasonably high number at the moment. But what I'd be looking for perhaps would be, A, the interest rates, which looks like pretty much a done deal that the US would move on. And the second thing is, quite like Paul, perhaps with the beer in hand, I look at some of the data coming out. It's popcorn stuff, because come the end of Q3, it'll start getting clearer who's on the right side, the IEA or OPEC. The truth might be somewhere in the modest middle as to where demand growth is going to go for this year. But it's be very interesting to note after the summer driving season stays over.
Well, it certainly will be, and we will have to leave it there and see where Brent crude oil is trading right now, just above $85 a barrel. And in that, we have the end of our season. And we want to thank our three guests today, and not only thank them for today, but for their contributions throughout the season. Kieran, Paul, Gaurav, thank you so much. Have a great break, and it's hopefully we'll all get some time off in these coming months. And certainly, as Kieran says, when temperatures are going above 50 degrees, it's probably time to find geography for a brief period in order to not be too exposed to those kind of numbers. But Europe, as it turns out, as we started our conversation this morning, is being exposed to not quite those numbers, but high 30s to 40 degrees with an infrastructure that is no way capable to deal with them. And whether the refineries are or not, we'll have to wait and see. But clearly, this is a growing issue for more mature economies who don't have infrastructure but are now dealing with big heat. We'll leave it there. Thank you, guys. Have a great summer. We'll see you all in September, and hopefully in Fujairah on October 1st and 2nd for our annual forum. But until then, take care. Thank you.
Thank you.